The U.S. Inflation Reduction Act, or IRA, is President Biden's flagship legislation to drive investment in domestic energy production. At the same time, it seeks to promote clean energy. It was signed into law in August 2022. Effectively, it's a $369 billion bill to deploy tax credits across energy transition technologies. Recent estimates project an additional $400 billion of investments, and this figure could grow even higher. IRA also introduced industrial policy with a focus on supporting domestic manufacturing of clean technologies. For example, there are large incentives designed to reduce China's dominant position in areas like solar and batteries. Since its enactment, we have seen a sizable increase in clean energy and tech projects, as well as manufacturing investments. Investment announcements in clean tech manufacturing have increased by 60% to more than $114 billion. Most of these are for batteries and solar components. Around 80,000 jobs have been created, mainly in rural communities. Additionally, investments in clean energy have been spurred by the IRA, with more renewables capacity being built and requesting interconnections to the grid since the IRA.
A key investment theme that we have spoken of now for several years is that of a capital investment supercycle in America. The Biden administration has introduced several policies to, in fact, support this thesis. This includes not just the Inflation Reduction Act, but also other infrastructure investment policies, namely the Infrastructure Investment and Jobs Act, as well as the CHIPS Act. At their core, these policies aim to revitalize America's aging infrastructure and return its manufacturing, including semiconductor manufacturing, back to America after decades of globalization has carved out its industries. These policies also target improving America's resilience against climate change, both through climate mitigation or decarbonization, but also climate adaptation as America faces more severe weather events such as drought and flooding. Many of these policies do indeed have bipartisan support, particularly the reshoring of US production. Irrespective of the outcome of America's presidential election, the trend towards greater protectionism will continue. In fact, Trump plans to ratchet up protectionist measures with a proposed increase on import tariffs on all America's imports, not just Chinese. To offset this impact, we believe investments in domestic supply chains will be sustained, including investment in onshoring green technology supply, which is currently dominated by China. But there are also other key structural themes underpinning infrastructure investment in the US. The electrification of the US economy, from its mobility to buildings to industries, along with the growth in power-hungry data centers, buoyed more recently by the accelerated uptake of artificial intelligence technology, all point to a decade of rising power demands for the US economy following decades of flat growth. This rise in energy load growth will require large-scale investment to upgrade America's power grids. To take advantage of this, we are invested in electrical industrial companies such as Eaton and Schneider Electric, as well as other infrastructure-exposed industrial companies, such as the commercial heating and air conditioning supplier Trane Technologies. These companies have already enjoyed a step-up in growth, supported by so-called mega US infrastructure projects, that is, projects with an announced value of more than $1 billion. In fact, per Eaton, since January 2021 until the end of June this year, a cumulative value of $1.4 trillion of US megaprojects have been announced. And Eaton noted no slowing in the number of these announced projects, despite recent election uncertainty. But with data centers and renewable power generation projects now growing faster within the mix.
If Vice President Harris and the Democrats win, then her administration is expected to continue with the initiatives. However, Trump's campaign includes plans to repeal the IRA if he wins. This means we need to consider the election outcome from an investment perspective. The market consensus is that the risk to the IRA is binary. There will either be a full repeal or no repeal at all, and that due to IRA-related job creation and economic growth, a full repeal is unlikely. A full repeal is unlikely for a combination of reasons: political, economic, and some consensus around policies that were already in existence. But adjustments to the IRA may be needed due to concerns around the deficit. We don't think the IRA will be fully repealed, as many programs are designed to move supply chains from China to the US, especially in clean tech. So, on balance, we think a partial repeal could be more likely given Republican plans to extend Trump's era tax cuts and the need to find budgetary offsets. The risks associated with a partial repeal, however, are underappreciated. A partial repeal will see a weakening of three components of the IRA package. These are reducing tax credits, cutting funding programs, and revising green-related regulations. In this scenario, the sectors that we think are most at risk are electric vehicles, offshore wind, green hydrogen, and to some extent, renewables. However, there could well be differences between rhetoric and action. The previous Trump administration extended tax credits for solar. In fact, renewable electricity generation and oil production rose in similar measures under both administrations, as energy independence is a matter of wider national security focus and more resilient to political change. Also, regardless of the election's outcome, we think industries and policies with bipartisan support will have a higher likelihood of approval and implementation. These include energy infrastructure projects, nuclear, onshoring of supply chains, especially in clean energy, and a future US carbon border tax, which will support domestic manufacturing.
We believe renewable energy, namely onshore wind and solar, will play an increasingly vital role in helping America meet its rising power needs. And the reasons for this are economic rather than just environmental. Renewable electricity is generated from free inputs, the sun and the wind, helping to bring down customer power bills over time, as well as not being subject to fuel price volatility. In fact, renewables are now the lowest cost option, as well as the quickest power source to bring online for almost every state in America. Falling interest rates and input costs, which both spiked post the COVID pandemic, will also help to support renewable project returns and in turn help to mitigate any potential IRA policy changes under a Trump government. In our global funds, we are invested in Florida utility operator and America's biggest solar and onshore wind developer, NextEra Energy, who stands to benefit from at least a decade of visible growth in both power demand and renewable investment. Although a Trump win would initially be perceived as negative by the market for clean technology companies, we don't believe his win will derail what is in fact the multi-decade investment theme of a green transition in America's energy systems.